Hi guys. So in the previous video, we have seen and discussed the initial public offering as the first and you could say like most probable alternative for raising equity funding, right, in the world of corporation. So we moved from a closed corporation to a limited corporation, meaning that our stock has been listed on a stock exchange. Okay, today we'll continue with the second part, still about raising equity funding, but today we are going to see the private placement, especially for a startup that is experiencing a spin-off process or mechanism. Okay, um, so if we talk about initial public offering, like what we discussed in the previous video, um, so again, you shift from a closed corporation to a limited corporation, right? Meaning that now you list your stock, uh, you list your existing stocks on a stock exchange, and most likely you also issue new stocks. So the initial public offering and the primary market usually happen at the same time. Theoretically, we could separate these two activities or two mechanisms, but in reality, um, we most likely see like the joint event, right? Initial public offering and also the primary market. So again, today we're going to talk about the other side, that is the private placement, especially in the spin-off process of a startup. So again, from our discussion in the previous video, we know that a typical company would begin or initiate its life from the startup stage, right? So we build a startup and we start like serving the basic target markets that we wanted, right, when we built or started the company. But along the way, when the time passed, we might be able to improve and also expand in terms of uh, the size or the region or any other type of expansion. So we would need additional financing. Maybe at first we still could do the bootstrapping, right? Bootstrapping method, meaning that we use our own money, our own savings, or from you got the money from parents, from friends, right, colleagues, and other or other people or other uh, entities, right, that had like a close relationship with you. But again, up to some point, you may not be able to borrow further, right, because your debt capacity has been maxed out. Right? So you cannot borrow further. So that might be the time uh, to start the raising the equity, right? So you need to expand your equity. You need to invite other like potential stockholders or potential owners to join the company as owners. So again, we have two alternatives. So in the previous video, we saw the initial public offering, and today we are going to see the private placement. So you sell the equity by existing and also new shares that you are going to issue to new stockholders or new owners. Okay, so let's talk about it now. Okay, so when we talk about startup, um, And evaluation, with respect to the valuation of startup, we have like different stages here, see? So usually we start from this one, the early or earlier stage, right? So see the maturity is the lowest, right? So we started a company, or maybe we took over another startup, or yeah, any kind of way that we could take, right? So what about the funding sources here in the early stage? Maybe we relied on seed funding, from maybe another organization, uh, maybe a certain company with the corporate social responsibility program, or yeah, certain agencies from overseas, right, from other governments, and we might also rely on government grants, right, because maybe we are involved in like social entrepreneurship, or some other types of entrepreneurships or businesses that could help a lot of people, maybe, or could help certain part of society, or certain spectrum of the society. Angels, we talked about angels also yesterday, right, in the previous video. So angels, again, people who have like plenty of money. There might be like millionaires or billionaires, and they have a lot of uh, money to spend, right? They want to self-actualize, maybe. So so the potential of your startup might not be that bright, right, at the beginning, because everything is uncertain. Of course, it has big potential. It might have a big potential. It might have a lot of, again, opportunities down the road, right? But again, the uncertainty is very big. So there might be angels who have plenty of money, who are willing to try, right, to give you some money, maybe with a very low expectation of return, or something like that. So micro venture capitals, or venture capitalists, right? So we could find, again, venture capitalists has a fund manager who is managing the money. So the money comes from, so the pool of money comes from many sources, maybe from companies, from uh, individual investors, from institutional investors, and some other things, right? So venture capitalists. And then the valuation approach is mostly using the based. So cost based. So uh, how much money is required to replicate the business with respect to the costing, or the costs. That would be the main basis during this stage, because again, the uh, revenues and also future cash flows are quite bleak, like quite uh, uncertain at this stage. So I think the best measure that we can have is the costing. Then if the startup survive, and we could go to the second stage. We call it a scaling up stage. Right? Scaling up, so you could see from the name, like scaling up. So we are getting larger. It means that we survived the first stage, and now we want to get bigger, bigger market, and bigger target market, or even market segments. So we want to serve, I think, a broader market. So at this stage, I think the picture is still blurred, still black, but it has some level of clarity, a better level of clarity than it was in the early stage. So here we could attract angels and venture capitalists. And now the valuation approaches. We can use now two other approaches here. First one is the income or revenue, actually more appropriate to be called the discounted cash flow method. And the second one is the market method, or relative valuation. So again, a market approach, you use the relative valuation, you try to compare the value of this startup based on the approximate value of a similar company, right? A similar company that already had a certain value or certain valid value. So by comparison, we know that the value of this firm at the value of this startup would be approximately resembling that of the other company or the other similar company. So on the other hand, this one is discounted cash flow method. So we are making like projections of future cash flows, and then we discount them back, right? Discount them back to the present position. So we call it a discounted cash flow method. You can use the free cash flow to the firm calculation and also free cash flow to equity holders calculation. So FCFF and FCFE, right? So both of them are included in the we call it income approach or discounted cash flow method. So you see here, up to this point, we know that if you value your company too soon, so if you start selling or you want to sell your company at an earlier stage, um, the main weakness is you never know the true value, so you might sell it like too cheaply, right? Sell it at a too cheap a price. But the positive thing is you're free from the risk, right? You could imagine, uh, like some years ago, I think when Facebook was still developing, or we're calling it that here, scaling up, right? It was still scaling up. Uh, Maybe Bill Gates came to like Mark Zuckerberg to offer, let's say, $100 million. You could imagine $100 million was a big amount of money, right? But see the dilemma there. So if Mark Zuckerberg had accepted the $100 million, but let's say it turned out that no, and it turns out that Facebook is what it is today, right? With billions of the value of a billion of billions of dollars, then that decision would be painful because he had accepted $100 million, but unbeknownst to him, Facebook then developed and became like a multi-billion-dollar company, right? So that would be the painful decision. But you see, the risk was absorbed, right? So he would be free from the risk. But of course, from because we know that Facebook is a very successful company today, but put your shoes in yeah, put yourself in Mark Zuckerberg's shoes some years ago. I could imagine at that point in time, you didn't know what would happen to this company, right? And somebody was offering you $100 million, right? So that was a big dilemma. So if you accepted the amount, but if it turns out that the company skyrockets in the future, then that would be a painful decision, right? You will have a remorse or you will regret your decision. But if it turns out that the company actually goes broke, right, someday, then you would be quite relieved, right, to know that you sold the company earlier. So it's always a dilemma, right? A dilemma. But again, the point here is that if you sell your company at an earlier stage, the value would be quite uncertain, uh, and you might be you might be selling the company underpriced or too cheap. On the other hand, if you sell the company at a later stage, maybe at the scaling up stage, I think now the positive thing is you could use this one, right? You could use both approaches here. You can use the discounted cash flow method. You can use the relative valuation or the market approach. So now everything is clear. You can make uh, your cash flow projections better. More information is available. Uh, Clearer picture about customers, about potential market and everything. Right? But on the other hand, if you sell it at like later stage, right? Sell it at again, you sell it at later stage. Now the dilemma is now again the positive thing is you could estimate things better, but At the later stage, now you have a lot of, you might have some offers, right? And now it would be quite confusing. Right? At this stage, you have a lot of offers, uh, and those offers might be, conflicting one another. Okay, right? The scaling, you can imagine, right? The scaling up, so it's clearer. But uh, now there will be a lot of potential buyers that, yeah, make you a bit confused. Right? So it's always a dilemma. You sell it uh, too soon, right? It might be too cheap, but you want to wait. Uh, you can have more potential buyers as well. But now, here's another thing, right, about this, the waiting period. The company might not survive. So this is, for example, there's a one story that I knew. So there was a startup that initially looked very good, very prospective, and so there was a company, right? There was a company from another country that tried to offer, yeah, some little money, right, in the sense, like $200,000, $200,000 to the startup. So that was a little money, and the founders of the startup actually laughed at the offer because it was considered too low, realizing that they really had a big potential. So they rejected. So I couldn't say more about the identity of, or uh, the business field of the startup, because this might be confidential. But to cut the story short, this company rejected the offer. And 2 or 3 years later, it turned out that actually the startup went south and went broke. So actually, that decision to reject the $200,000 was a painful decision, was a remorse, right? Although it was a little amount of money. So you see here, again, if I could summarize, if you wait longer, right, the benefit is you have clearer pictures, clearer projections of cash flows. You could use both approaches to estimate the value of the firm. But the negative thing is during the waiting period, uh, the startup might not survive. And when you get offer at that level, scaling up, it might be confusing because there will be a lot of potential buyers that, uh, yeah, again, use conflicting offer conflicting numbers, and also contrary methods to estimate the value, and yeah, some other things. And then exit. So if the founders want to exit, by selling some shares or the whole shares to angels or venture capitalists or investment banks, so you can use all sort of methods, right, for calculating or estimating the value of the firm. So market approach, the relative valuation, or income or discounted cash flow method, and also cost replacement. So you could combine all the approaches. And at, I think, some point in time, because the company is getting bigger, if it survives, so it wants to serve global market, or at least regional market, or more likely global market, then it has to go through the initial public offering that we discussed in the previous video. So now you could sell the existing and also new stocks to pension funds, institutional investors, right? Investment banks, asset management companies, regular shareholders, right? Then most likely the approach should be the official method that with made by official appraisers. So we have to use the discounted cash flow method. Okay, so we'll go through this quickly. Again, the early stage, see here, company value is based on management team, product traction, also traction, the like number of visits, number of product purchases, right, during the observation period, the quality of product, how much investment is needed. So here again, the value of the company is quite arbitrary, quite abstract and uncertain. And we have seen this in real world. Uh, for example, the some startups, right, that actually made a lot of losses, like Uber or Grab, right, or Gojek, like Tokopedia, some similar types of firms. They made losses, right, during their first several years, but you see their valuations had skyrocketed since the beginning because of the big potential. So again, the early stage valuation would be quite uncertain, quite abstract. So again, if you're a startup founder and if you sell it at the early stage, again the benefit is you're safe because now you're free from the risk. But the potential drawback is you sell it too cheap, too cheaply. So because you don't really know the value, then you have to uh, offer your equity at a cheaper than what it should be, right? Or your full potential. Okay, and see some information here. Uh, pre pre-revenue stage. So valuation is based on how much investment is required usually. Right? This is so true. I see. Because of the big potential, many investors are willing to invest a huge amount of money for maybe the majority shareholding. Right? Investors expect a return in about 4 years. This may not be necessarily true. You see the case of, again, the startups that I have mentioned. Many of the investors are still waiting. It has been maybe a decade, right? About 9 to 11 years, and are still waiting for the real results, real yields of the investment. So how much equity can get in company, right? So they're negotiating the uh, shareholding, right? The proportion of equity that would be given to them. So scaling up here, we saw the two methods here, the relative valuation or market approach and discounted cash flow method. So typically generating revenues, and it has a working cash flow, but I think the early part of the growth period, right? So revenues, so investors seek out similar companies and determine, see, most likely, if you use the market approach, they will compare, right, similar companies, uh, their revenues, their cash flow. So we use comparison for this approach, right? Market approach. So if you are doing pitching here, right, I'm seeking $500,000 in exchange for 20% equity in the company. So where do these numbers come from? So this is very arbitrary, right? So your calculation might be different from your potential investors' calculations. So you have to negotiate there, based on so each other's expectations, and again you come to make a like, mutual agreement. Right? So what are you actually saying? So my company, for example, my company is worth $2.5 million, and within 3 to 7 years, or maybe 10, you'll be able to get a return of 10 to 30 times of your investment. How do I know? So all of these are full of like predictions or projections. So again, coming back to our story here, this is always a dilemma, right? Early stage and scaling up. Right? Early stage, less information, but again, the risk is low. If you let it go, the risk is low, but the information is also limited and insufficient. So if you sell it, most likely you sell it underpriced, right? At a lower price than it should be. But scaling up, you have more information, but the risk is higher because it might not survive, right? From the early stage to the scaling up, your startup might not survive. That's the thing. But again, if you survive and you sell it at a later stage, then definitely you'll get more money and more offers, more potential buyers as well. Although it might be confusing. So what is the purpose of the valuation? Uh, yeah, you can use the like license. License means you have a certain patent or certain intellectual property that you could license out to other entities or other organizations. Or you could do this one, raising investment by doing the spin-off. Right? Spin-off means that now you get out of uh, the certain shareholding or the current shareholders, like now you get out from that system, and now you are spinned off, right? You are spun off into uh, like more independent company, having like new shareholders or new shareholding circle. Right? Again, a spin-off here means that maybe like now you are in a shareholding circle, right, with certain shareholders. Now you are spun off. That's why we call it a spin-off, right? Spin-off company. So you are spun off to be an independent firm with a new shareholding circle. Okay. So raising investment by spinning off or by selling uh, a license, should you have the intellectual property or patents or something like that. So what's the method here? See the methods. So we have seen these three methods: the cost replacement, uh, relative valuation, or market approach, and discounted cash flow method. And here, VC method, raising investment, right? You can use the VC method to determine the pre and post money valuation. Okay, investor types and their expectations. Again, we are talking about private placement. So if you choose the initial public offering and you're a startup, uh, you can choose, like there are three boards. Usually, right, in a stock exchange, you have the main board, you have development board, and you have acceleration board. So acceleration board is like startup board. So you might, you know, choose to be listed on the acceleration or startup board, or you could simply choose to be on the main board or development board. So some investor types: banks, angels, like we saw it before, angels, people with plenty of money who are trying to invest, right, because of certain values, because of self-actualization, or simply because of potential profit. And venture capitalists here is more formal, right? So uh, a venture capitalist or fund manager is managing a pool of money sourced from many sources or from other investors. You see funding circle, right? Certain maybe communities or societies or organizations. And this is the most basic one, right? So if you use your own money or your family money, we call it bootstrapping. So you bootstrap, meaning that you extend the funding by yourself. And of course, the new sources like peer-to-peer lenders, peer-to-peer companies, peer-to-peer lending companies, or crowdfunding platforms. Now, even we have peer-to-peer lending. So this is borrowing. Surely you see the name here, peer-to-peer lending. So you borrow money, right? Instead of from a bank, you go to a P2P lending firm to borrow money. That could happen. But we also have ECF, equity crowdfunding. See, equity crowdfunding. So this is interesting one because this plays, so this type of company plays a role similar to a stock exchange actually. As a mini stock exchange because the ECF uh, is receiving money from investors. So you could imagine if this is the ECF, it will receive money from investors, individual investors, and of course, super investors or super, uh, you can call it super lenders or super investors, the big investor with the uh, majority money chipped in the ECF, and then the ECF would invest in startups not as lending but as equity, right? So the equity here, equity there, certain percentage of ownership, right, in many companies that it chooses to invest in. So ECF, you see, this is quite similar to the maybe equity mutual fund, similar to, or you can call it mini stock exchange even, because yeah, so not really a stock exchange, but closer to equity mutual fund. So we call it equity crowdfunding. Types of exits. So merger and acquisition. You might be acquired by another company or a bigger firm. You've seen something like Facebook acquiring WhatsApp or Instagram, right? Something like that. IPO, we saw this in our previous video. This is the initial public offering. So you list your existing shares on a stock exchange, and we also sell new shares to the market or to the public. You can sell it to employees, you can sell to another person, uh, uh, you can pay, yeah, dividends, like part of your dividends are taking the form of like stock option, so the stock dividends instead of cash dividends. And also you could choose to liquidate and close. You liquidate, you sell off your physical assets or your intellectual properties, and then you close down the company. Okay, what type of business is likely to get a return? So when you hear about startup, like potential startup, we always dream of uh, that huge return, like 10 times or 100 times or something like that. Because now everybody's dreaming of being like a startup with market value of more than 1 billion, right? So we call it what, unicorn. So unicorn company, right? And even some startups have had or have been estimated to possess a market value of more than 10 billion. They call it what, decacorn. This is more than, it's expected that the market value is more than 10 billion. So everybody dreams of, being a unicorn or decacorn company, of course. But see the reality here, for every 10 investments, you see, based on again the based on survey and observations, we see that uh, three of them might fail, right? So three of them, like 30%, and break even is about three. What about a return between 1.5 to 3 times? Also 30%, and only 10%. One of 10 is giving you like 15 times return. So it's quite small percentage, right? 10%, so one of 10. One out of 10 investment will give you more, maybe 15 times return. But again, 30% might fail. So it's quite natural here, right? Natural thing in the startup business. So how investors see you, potential money, putting, it's like putting a seed on the land, and they want to reap the harvest within maybe 5 years or 10 years or something like that. So we see the valuation right now, valuation for the, especially for the private placement, not through the capital market, but private placement by the venture capitalists. So again, come to your company, they offer certain amount of money for in exchange for a certain percentage of equity in your firm, right? So they do the diagnostic and then they do comparison. They estimate using other methods. Remember, we can use a relative valuation, this one, right? Relative valuation. Can use the discounted cash flow method. They can use cost replacement or some combinations of them. So they determine the multiples, right? And they could estimate the risk adjusted discounted cash flow and expected NPV. So they could make a lot of scenarios and find the expected NPV, and then uh, revenues to exceed, when and how much to exceed, and how much they want to reap at the harvest. So let's see, before we see an example here, some terms that we could put in mind. Pre-money valuation. So pre-money valuation is the value of the firm before a new equity investment is coming in, right? So that's why the name is pre-money valuation. So post-money valuation is of course the opposite, right? So this is the value of the equity after the equity investment, right? Value of the firm after the new equity investment. And the equity investment is the amount of money invested in exchange for, again, the shares, right? Certain percentage of shares in the company. And the equity stake is the percentage owned by a shareholder. So harvest value, what is harvest value? So when a venture capitalist or individual investor or an angel chips in, the company by investing certain amount of money, so he or she might start estimating the selling price at exit. So we call it harvest value. So the time to harvest could be 5 years later, 10 years later, or something like that. So the terminal value here, so PE ratio, we have PE ratio from the relative valuation method. So this is the price or the value of the company divided by the earnings or net income per share. So the value or price per share divided by earnings or net income per share. So you took it from a similar company or a relatively similar company, right? And then you multiply it by the net income or earnings per share at the exit year, right? So you could estimate what would be the value, right, at the exit year. And you could see the logic, right? So the price to earnings ratio taken from a similar company, and then you multiply it by the projected or predicted earnings per share or in net income per share in the exit year, and then you could estimate uh, the value or the price at the exit year. And then you have return on investment. Here, return on investment is, remember, harvest value again. Harvest value is the value at which you will sell this startup at your exit year, right? So if you plan to exit in 5 years, that would be the value of the estimated value of the firm in 5 years time, right? Divided by post money value. So again, this is uh, the value right after the investment is made. Right? So right now, for example, the value is a certain value, and there's additional investment added, right, to the company. Then the post money value is the old value plus the additional investment. So you could see this is called what? Return on investment, right? Your harvest value, right? The value that you have at your exit year, or at least your estimated value at the exit year divided by the post-money value. So the value when uh, the investment firstly came to the company, right? So post-money value. Okay, so you see here, based on research, you can see some industries will have certain industries will have like different pair PE ratios. They have different PE ratios. You see the big one, like biotechnology. Biotechnology has an average price to earnings ratio of 321. But the small P ratio, uh, for example, is building materials, or uh, classical, more classical and traditional industry, right? So building materials, it has a lower P ratio. So the growth rate has been lower. So again, P ratio is usually representing the growth rate, right? If you're a growing industry or growing company, then most likely your P ratio is still high, because again you're comparing or finding a ratio between the current value or the current price to your net income or your earnings. So if this is very high, it means that you're growing fast, right? So your growth rate is faster because now you're selling. The value of the firm is uh, much higher than the net income, right? So the growth potential is still very high. But if the P ratio, the pair, has been lower, it means that the growth opportunity is more limited, right? So it's more, we can call it a value company, right? Value company instead of growth company. And you can see other things like pharmaceutical is also having a very high PE ratio. Renewable energy, you see all the uh, new and uh, new and modern industries are going faster, right? Because this is modern times. Uh, so those kind of industries fitly, you know, uh, or we can say they really fit the times, right? So we're seeing that huge growth rates by those industries. So harvest value, again, this is the uh, projected value of the startup, excuse me, at your exit year. So typically 4 to 7 years, could be more. Right? So every investor will have his or her own uh, expected exit year and also harvest value. Right? This makes it interesting. Remember our discussion earlier that if you are scaling up at the scaling up stage, you have a lot of offers, and it might be confusing because uh, every one of your potential investor is estimating its own exit year and harvest value, and of course return on investment. Okay, again, return on investment is the harvest value. Again, the value, uh, the estimated value at your estimated value at the exit year divided by the post money value. So post money value is again the value of the firm when new equity just came in, right, or firstly came in. So we see an example here. Uh, yeah, see here, example. Uh, let's say we have this secret information. Of course, this information will not be shared with the potential target, right? If you're a potential acquirer, you are a venture capitalist, or you're a private equity company, or you are an angel, or anything like that, you will not share this information to your potential target, right? So you keep it for yourself. But let's assume that we know this information. You exit After 5 years, how much revenue will you be generating? You estimate that the startup could generate 1 million euros, right? 1 million euros at year five, right? At year five, it will generate 1 million euros. And what is your expected profit in exit year? So we're saying 110,000. So again, this is your expectation, right? Your projection. It means that it would be about what, maybe 11%, right? The profit margin, yeah, would be about 11%, right? So this is your expectation, right? There's no, yeah, of course you have your own formula to determine that, but again, this is arbitrary. It's hard to say that your estimate is right and another person's estimate is wrong or something like that. Hard to say. So what is the PE ratio for comparable companies? You say 20 times, all right? Again, PE ratio is the price to earnings. So basically the current value or current price of a firm, right, divided by its earnings per share or net income per share. So you get this from uh, comparable companies, similar companies, or companies from the same industry. And then, so what do companies in my industry typically sell for? So this is like, uh, I think the revenue per so the sell price to sales, I think. So this is a price to revenues or price to sales. So this is the ratio between the current value of a company or current price of the company divided by sales or divided by revenues. So here in this information from the comparable method, we find out that similar companies have the price to revenues ratio of 2 times or twice. How many shares did you create at incorporation? So the company, uh, you know, during the incorporation, right? The company had the articles of incorporation, right? It has a charter, right? And then by laws, right? And the charter is called again articles of incorporation. So it's mentioned during the incorporation that the number of shares outstanding right now is 1 million. So how much do you want to invest? Let's say 50,000, the first stage, and then maybe in 5 years, uh, it's 1 million. So what is return on investment that you want? Again, return on investment. Again, this is a harvest value divided by the post money value. Harvest value, right? The expected value at the exit year divided by post money value. This is the amount, the value of the company when the 50,000 comes in. And what is the expected internal rate of return is 50%. So we see an example again here. We continue with this example. So exit year is 5 years. Right, we saw the information here. So 5 years, and then again based on your estimation, at year five the revenues would be 1 million euros. Here 5 years, it fits the typical exit year, 5 years. But nowadays, uh, we see that investors are willing to wait longer and longer. You can watch my video on real options. I talk about this. Actually, we have like a longer period for real options. Right? Profit margin is 11%. Right? So you could 11% at year 5. So at year 5, you see here the estimated like profit, right, or earnings, right, to revenues is 11%, and you expect the revenues to be, this would be what, 1 million, right? So let me write properly. So again, the revenues, and here is 11%. So profit margin is your net profit or net income or earnings divided by your revenues. This is 11%, right? So you know that you expect to get 1 million, and you want the ratio to be 11%. So the expected profit or net income at year 5 would be 110,000, right? The multiplication, right? Okay, 110,000, that would be your earnings at year 5. So P ratio, this is estimated from your from comparable firms. It is 20 times. Again, P ratio is price, right? Current price or current value divided by earnings or net income. This is like 20 times. And then this one, uh, actually, this is more appropriate to be called like price to sales. So this is like should be reversed, right? So price to sales is 2 times, right? It's twice. So price to sales, current value of the company or current price divided by sales or revenues. Right? And the return on investment that you want, again, is 10 times. So return on investment is harvest value divided by post money value. And then how much investment that you want to invest? 50,000. So you want to estimate if you invest 50,000, how much shares should you get, right? Or how much shares should you negotiate with the startup? And see here information here, dilution factor is 25%. So further dilution will happen after 5 years. So you expect that after 5 years, the company will open up another round of investment, uh, thereby diluting your share right now. So you don't want to lose you don't want to lose your shareholding because of dilution. So you want to incorporate the dilution factor into your current calculation. So we'll see how you do it now. So what about the terminal value, right? Terminal value estimation based on PE ratio. So here. Okay, so here, um, okay, we know the PE ratio is 20 times. Or just simply erase everything. So you see the P ratio, based on the P ratio, this is 20 times, right? And we know that the earnings, see, we estimated here together, right? So earnings at year 5 is 110,000. So you could estimate, right? What would be the price or the value at year 5? Again, the price to earnings ratio is 20 times based on comparable firms. And then we know that the estimated or projected net income at year 5 is 110,000. So if you multiply them, we get 2.2 million euros based on the PE ratio method. What about this one? Price to sales method, the PS, price to sales or price to revenue. So the same analogy here. It's equivalent method. So revenues, we have estimated revenues at so again, what is the ratio? Price to sales is twice, right? 2 times. And we know that the uh, revenues at year 5 is 1 million, okay? And the ratio is 2. So you could estimate again the terminal value or the harvest value, right? Terminal value is 2 million, right? Based on sales to, sorry, price to sales method or price to revenues method. So if you find the average, 2.2 million based on P ratio, 2 million based on price to sales. So uh, the average harvest value or terminal value would be 2.1 million, right? 2.1 million. Okay, so now we know the harvest value, and we also know this one. You see the ROI multiple 10 times. Again, from the story here, we expect a return on investment of 10 times. Right? And we know that the return on investment is harvest value divided by the post money value. So harvest value, we just estimated at 2.1. This is the average. So 2.2 based on P ratio, 2 million based on price to sales ratio. So the average is 2.1 million. So if we want a return on investment of 10 times, so we know that this one is 2.1 million on average. And we know that the ratio is 10 times. This is the return on investment that you want. So you could estimate the post money value right now. So by dividing, right? By dividing, so 2.1 million divided by 10, so you get 210,000. Okay, so you know that after the investment of 50,000, the value would immediately be 210,000. Okay, so 210,000. So now you know that the post money post money valuation is 210,000, and we know that post money valuation is essentially the pre money valuation plus investment, right? The investment that is chipped in. And we know that here we just estimated the uh, post money valuation. The post money valuation is 210,000. So this should equal pre money valuation plus, and we know the amount of the investment, right? 50,000. So immediately by using this method, you know that the current value, that's why this is called pre-money valuation. The current value before the 50,000 investment comes in is 160,000. You see the difference between 210,000 and 50,000. So you could using this method you could estimate the current value of the company that you're going to invest in. So about 160,000. Yeah, 160,000. Okay, so how much is it? How much percentage? How much percentage of the ownership you should negotiate or you should ask for again in exchange for the 50,000 investment. So here you could estimate uh, what is your investment again? 50,000, right? 50,000 divided by the pre-money valuation is 160,000. I could imagine, right? If you are going to invest 50,000 and based on your uh, calculation, right? Based on your valuation, the current value or the pre-money valuation is 160,000. So this constitutes 31.25% of ownership. So if you chip in 50,000, you should ask for at least 31.25%. Of course, the end result will depend on negotiation, but this is a number that you can bear in mind in your negotiation. Right? Yeah, quite straightforward. So again, with 50,000 investment, you would ask for 31.25% ownership in the startup. What about this factor again, dilution factor? So you expect that the company might open up a new round of investment, maybe in 5 years, right? So with a new round of investment, suppose that they offer new stocks to other stockholders, other investors, then your uh, 50,000, your 31% would be diluted. You could imagine that you have uh, this is the pre-money value right now, and you invest 50,000. So now the size is larger, but in 5 years time, in 5 year time, they will open up a new round of investment, and now they will add more share. So now your share will be diluted, right? So previously, or right now, you will have like 31.25. But 5 years later, when they add or they invite more people to join, this might become 25 or whatever, right? 20 plus percent, maybe 20% or something like that. So if you don't want uh, to lose something because of the dilution, then you negotiate further, right? You increase or you enhance your negotiation. So here you see, okay, so you don't want to accept the dilution for free. Again, it depends on negotiation because some investors are just willing to take the risk of being diluted, but some of them will be like a hardcore negotiator, so they don't want to lose any penny. Right? So what is the pre-money value by taking into account the dilution factor? So the pre-money value is again in this case 160,000 based on our calculation just now. 160,000, but you don't want to admit the 160,000 because you're saying, so I know that in 5 years time, uh, you you open up more investments, right? You offer your equity to like additional investors. So if I chip in 50,000 right now and I get like 31%, I know that in 5 years, the 31% will be diluted. So I don't want to accept the fact. Uh, I don't want to lose a dime. So I want to no clean up the calculation, right, by including the dilution factor. So 160,000, I don't admit the value right now, but I want the uh, dilution adjusted pre-money value. So 160,000 times 1 minus uh, what is dilution factor here? 25%. Okay, so now I only want to admit the pre-value money or pre-money, no, sorry, pre-money valuation of 120,000 euros instead of 160,000. I want to admit 120,000 only, the pre-money valuation, right? Because of the potential dilution after 5 years. So what about the new calculation? with the pre-money valuation of 120,000 instead of 160,000. So we recalculate. So 50,000 here. I want to chip in 50,000, and I only admit that the current value is 120,000 and not 160,000 because of the potential dilution within 5 years. So now I will negotiate to get 41.67% right now instead of 31.25. So whether or not you are successful in negotiating will be another story, because we are not talking about that negotiation skill or business communication or something like that. But this is very important to know that if you want to take into account uh, the reality or the fact that dilution will happen in 5 years, then you might want to use this one. This is a dilution adjusted value right now. Instead of 160,000, we only want to admit 120,000. But if you don't mind uh, being diluted 5 years later, then you simply use 160,000, because that's the present value, or the pre-money valuation. So the value right now before the 50,000 comes in. Okay, so very interesting. So this method is the venture capitalist method. Uh, a lot of simplifications are taking place here, right? So a lot of simplifications are prevalent. Uh, of course, a formal method, if it involves a lot of money, uh, we must use the discounted cash flow method. That is the more comprehensive and formal method or approach to estimating the value of a startup. But if you are a venture capitalist, you want a quick estimation with like unclear information, no sales projection, no cash flow projection, then you could use this simplified method or quick method to assess or estimate the value of a potential startup. Okay, so we have seen the private placement, especially using the venture capitalist method. So uh, in the in these two-part videos, we have seen both the initial public offering and the private placement, and I think the trend will increase, right, with respect to the uh, raising equity funding for, especially for startups, right? After 10 years maybe, or after 5 years even, if it is going fast, and we'll see this more and more in the global market. So this kind of valuation, both for initial public offering and also for private placement, will evolve as well, right, from time to time. There will be new techniques, and I think the uh, real option valuation has been, widely accepted and also implemented in the estimation. So if you have time, you can watch another video of mine about real option. There we see a lot of potential uh, alternative or scenarios in some periods to come that might affect your decision right now, right? Whether to invest right now or to delay to a certain period in the future, maybe 6 months, 1 year, or something like that. Okay, so I hope our discussion today would benefit you in your endeavor as an entrepreneur or as a startup owner or even a venture capitalist. So hope to see you again in our next video and discussion series. Thank you and bye.